I am probably the biggest bull in the house, and I'm going to keep calling it. And, there's many like me, I think.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the market sniper. Francis, thank you so much for joining us today.
Delighted to be with you again, Elijah. And another all-time high day on gold, isn't it?
Well, it's fantastic. Yeah, we're seeing gold just skyrocket higher, really getting close to that $2,600 level. We're recording this September 12th, 2024, and we'll be posting this tomorrow morning at 9 a.m. Pacific, 12 p.m. Eastern time. So I did want to get your perspective on what is happening this morning and throughout the day here on the 12th.
Well, just little bits of data rolling in, but none of them are the real reason why this is happening. They're just increments of the larger, massive pile, the small increments, but it's a debt-based collapse. We are in a debt-based collapse. We are saying goodbye to a fiat and debt-based system in an accelerating environment where the debt deflated immensely from the pandemic events of 2020 through to about 3 or 4 months ago. It was all on the debt side, and the dollar was fairly firm. And now we've seen a dollar weakness. So there's two legs, and we're having to release this pressure in this debt creation, water tank, this hot water tank. It's almost like a geyser that wants to blow. And this is what happens. And more people are turning to the monetary historian of millennia, which is gold, because you don't want to be a holder of debt and you don't want to be a holder of dollars. And this is also a stagflationary environment, which was the seeding ground. Let's just remember Nixon of the Vietnam War fame, that was overspending and bombing to such a huge degree in the military industrial complex, was actually overspending what was spent even in World War II. Many people didn't clock that, because it wasn't in Europe, it wasn't making the news. It was some faraway nation which spoke a different language. And that led to, of course, the 1971 going full float and the cessation to have this nasty restricting precious metal tie. And that led to the single biggest gold boom that took gold to $800 in then dollars terms, which on a CPI adjusted basis, even today, we haven't got close to meeting on their CPI, which I think there's a lot of skepticism around. So, stagflation, 70s, similar take, only a much bigger crash to come. I am probably the biggest bull in the house, and I'm going to keep calling it. And, there's many like me, I think.
Moving forward from here, obviously we're at all-time highs for gold. Did you want to share the screen maybe and give your technical analysis of where do we go from here? It's kind of maybe difficult, obviously, because there's no resistance from here, but your take on this, that giant green stick we're seeing there.
Exactly. This is the daily chart, Elijah. We, in our community of traders, we were highlighting that we had our favorite structure in there, which we call a volatility squeeze. And you can see it there. And this is the setup that for a while, the 5,000, my apologies, that I'm talking a little in the future when I say 5,000, sorry, the $2,530 mark was serving as a degree of short-term resistance. Was a degree of short-term resistance if we have a look at it as a straight line here. And there was, of course, this squeezing along the bottoms So we had a couple of sell-offs, each time getting bought up higher, and now we've smashed it. And you're watching this on a 4-hourly now, and we're literally at the all-time high, pushing higher. We're about to do 2560, which means, of course, we're closer to the 2600. This is on a shortish time frame. We're on the 4-hourly, so we're watching history being made and the rollout. And don't forget, Elijah, on the bigger time frames, we've come on and said the doorstep of 3,000 is one staging post. We've given 6, 8, 7.5, and a number of others, all that have come technically out of the bigger time frame charts. But in your question, you were probably asking, many people fear buying a high. You know, it's kind of like, oh, I don't know if I should get in touch with Elijah and his team to make gold purchases. It's clearly at a high. I should be waiting for the dip. And I did prepare a couple of charts along that line that I want to actually show to you. I'm going to take this off a log and explain what I'm showing to you here as well. This is gold, the precious metal, divided by the longest standing index, which is equity index. So we're doing a gold versus equities comparison at the moment, Elijah, against the Dow Jones Industrial Index. And this goes right back to 1897. And so we had, I would argue, a culture of equity slowly being developed that saw the monetary metal be devalued. You almost had a range down like this. And then we got some of those events that I was mentioning when I was referenced Nixon in 1971. And in this chart, I've sort of nipped the top 5% on a red line, which is possibly not a bad place to start taking some profits. There's eventually a point where, you know, you can switch some gold into something else. That point is a long way from happening, but there is a point of valuation when everything is too gold dominant. Maybe get property, agricultural land, something else. And here's the super underappreciated, undervalued zone that I put in green. And for those that are thinking and looking at this, this is a 3-month chart. So each candle is a quarter, and it's a, you know, it's a 125-year history. So to get the macro picture, for those thinking, I shouldn't be buying at 2560. It's an all-time high. The good news is this is one of the biggest cycles I think you're ever going to face. You're going to see a planetary, globally synchronized, debt-based event that is going to be so all-encompassing. We've never been so economically connected that could even make the 80s to Dow Jones ratio look, you know, look paltry. You could have a move beyond that. And just to give some values to this, the gold divided by the Dow Jones, right now, Elijah, we're at 0.062, that valuation. So that 2,560 divided by the Dow's big number, you're at not even 6%. The spike of the 80s actually was a hard 1, so that's 100%. So, you know, if you think we could be as bad as the 80s or could even go part the way there, there's an immense amount of upside. Just getting to the around the high zone that I've highlighted, where it's typically been a good point to start taking a little bit of profits. You would have to go about 7 times in the benefit of the ratio of gold to benefit gold. So either gold goes up 7 times and the Dow stands still, or the Dow has to sell off a little bit and gold goes up 5 times, or if the Dow in an inflationary environment, remember, can still inch a little bit forward, gold goes 7 times an already increasing Dow. So these are, you know, this is early doors. People do not have gold in any meaningful manner, the average man, in their portfolios right now. So even thinking now, it's early doors, get out and do it.
It really is shocking to see how undervalued gold is with respect to the stock market from that chart there, and how high gold has been in other times. I did want to ask you about silver as well. We are seeing a pop in silver today, it really racing back towards that $30 level. Are you as bullish right now on silver as you are for gold?
It's a good question, and silver will respond. There is a slight element that I will add to, I am a macro bull on both. and eventually more so on silver. But I would say this could be such a big cycle that the gold dominance stage, where the best moves are in gold, could extend a slight bit. It's good to see silver moving, but silver is not yet at new highs. And the key criteria for measuring when silver is invariably, for me, the gold-silver ratio. So rather than just bring up the silver chart right now, I'm going to bring up I see both going up, but the point that we most want is when silver is consistently going up faster. And that's when you have, the turbocharged moment. And you may recall silver had its moment potentially to shine when it broke here. We felt this could be a beginning of a major breakdown through this level, but it didn't hold. It couldn't close below the 75, and then it rallied quite strongly. We are now getting a little bit of silver strength again, but I would argue that this technical pattern that I'm drawing here says it could be a longer cycle first. I think people are going to transition too quickly. There is a slight element. I kind of put gold, copper, and silver closer to gold than copper, but in between. There is an industrial component that's a bit larger on silver. And right now, industry, as I mentioned, copper, which has had a bad crash. I'll also point to oil. We were on the yen trade unravel of August the 2nd saying short oil, go long gold for a commodity neutral. These other commodities, and I'm a fan of the macro bull, but I've always said, be in the monetary commodity gold in a debt-based crisis that is of money. Debt and money go hand in hand. Do not be in a commodity that relies on retail support when the retail consumer is getting destroyed. So I've stayed clear of the energies and oil. And the reason I've dragged you into that territory is, to a degree, copper's industrial use and a slight element of silver's industrial use. A decrease in general demand will keep a lid on it. So until I see a technical pattern that is suggesting that silver is about to go in and break this lower level, which is around the 75, I'm going to play the full first stage of this bull market by asserting on gold first. Long run, silver wins far harder, but I don't want to be too soon, and we can pivot. So for now, I'm saying it's coming, but not yet.
Now, when it comes to the big picture, it sounds like the main driver of this rise in gold is the end of this fiat currency system, right? You're talking about a currency destruction, and we're coming to the end of that, and it's going to be a global crisis. I did want to ask you, do you think there are any more immediate catalysts for this rise today? I know the ECB had a rate cut. We saw inflation data yesterday. What are some of the factors that you think may have played into this immediate large rise today in both gold and silver?
So short term, if you're asking me why today and this week have we had this buoyancy, we did have core PPI, my apologies, that's producer price inflation. And what it had is you had a beat there. That means the producer's costs going in are beating expectations. You had 0.3 instead of a 0.2 expectation. You had a beat on the PPI monthly, month to month as well. So you're getting some consistency in the stats that's saying you haven't yet won the war on inflation, and gold's role, of course, is holding value in inflation. So what the markets might be, and it's not for me to say what they're doing, but I can supposition potentially, is that the war and the victory over inflation is celebrated way too many times only for it to return with a bang. And what you're actually seeing is if the producers are having to pay more for their inputs than expected, and it's not demand driven. Remember, retail, consumer all down. You've got China in a bit of a downturn. They've had stock market collapse, a lot of things. They're running the yuan low. You're running the dollar low. Everybody is looking for an export advantage. Nobody is selling a lot, but you're getting stubbornly high input costs. on the producer price inflation, that's going to still come out on the consumer price inflation, because margins can only take so much compression before prices are going to have to rise again for producers. So there's that. I would also add, just because I'm talking about the demand not being there and the consumer wrecked, this was a beat on the unemployment claims as well, which is showing that the economy is doing worse in terms of retail employment. And you'll remember that we weren't in a recession when we met the criteria for a recession in October of last year, because of this red hot labor market, which has since seen a lot of downside revisions, and one for the year that was at over 800,000, plus subsequent payroll revisions all the way through. And we're seeing that actually unemployment is doing badly and producer cost inputs are high. And this puts you very much in what I was saying again regarding the 70s and Nixon's era. And I'm not saying it's the same, it's not the same, but it has some of the same elements, and that is stagflation, bad economic growth, stubbornly high prices in a bid. So you have structural inflation for the long run, which will flare up many times. They didn't kill this beast when it was a baby. And the fact that you've just beaten him up for a little bit with rate hikes, he's taken a rest and he's going to come out of that corner swinging again. All of that is good for gold.
It seems to be a lot of bullish factors for gold here. Now, when it comes to the other precious metals like platinum and palladium, we've talked about that before. It seems like they're both running today. Platinum making a big move as well. Your perspective on those alternative precious metals, in your mind, where do they go from here?
Between the two of platinum and palladium, we've got a long-standing long-short inside the platinum group. So palladium is one of those that are under the larger platinum group, like platinum itself. And again, there's been a bit of substitution. Palladium got super, super expensive, and platinum is starting to get more of a benefit here. So, but I would just point out again, sometimes people overcomplicate this game by wanting to sprawl into other things and get super creative. I think gold should be pressed on for gains, and in due course silver. Platinum in some countries is attracting VAT. I don't think that's the case in the States, that there's additional taxes. It's also hard to get, and if you ever need to sell it, the liquidity levels might be slightly less. So it's super, super rare, and it's a fun to have, and I do have a touch of it. I wouldn't even have people get into palladium at all, apart from maybe a potential trade if you get the ideal criteria. But that said, they're part of the precious metals complex, and they will get bid if gold is running. And gold is running to new highs. It's pulling its sister, silver, along with it. These tend to be the distant cousins, and they will respond in sympathy, but don't get unnecessarily complicated. And I would choose, if you want one other, I would take platinum over palladium. I'll bring up the palladium chart as well, because it's actually been a while, and it's your question that sees me have a look at it. It's been a while since I looked at it. This is a super low. By the way, all those lines, it's super messy, but those were our targets on short targets that we called for palladium, when we were actually long platinum, short palladium, and those were all met down here. I think that's done for the downside of palladium, and you're seeing it at 1,046. It's brought it down from being a huge multiple to platinum. So actually the most interesting thing was for me in this question of yours, again, and I'm expanding your question slightly, but I think it's the point that's potentially the most interesting, was the relationship between the two, and how grossly on a macro level platinum had become undervalued, and this is now a bit of a turn in that valuation. So if we again, I'll put this is a long-term chart, but I'll just put it up in regular scale for you to see. This shows how platinum actually has always been generally the more valuable to palladium, and how much ground it lost from around the subprime. bust. And then a bit of structural substitution took place. And I think we're pretty early in the doors of putting in a bit of a bottom on this relationship between the two. You are coming out, although we are seeing a little bit of a selling now. There is a bit coming in for palladium. I would imagine this to start normalizing more to the upside in the long term if we were to have a precious metals bull. So if you are considering the two, I would bias to platinum on the base of historical lows having been put in on the platinum palladium ratio.
Right. And I know for silver and gold, I mean, the ratios of platinum to those metals, platinum is extremely undervalued, I think at all-time lows compared to silver and gold right now. I did want to get, again, I guess your perspective then on the big picture, what we're seeing maybe in the stock market right now and the other markets as we're moving closer in your mind to the currency destruction. Do you see weakness in, maybe the traditional asset classes out there?
It's a very good question. How's the stock markets? Because they represent obviously risk on. I did have the Dow Jones partially involved in our gold to Dow discussion earlier. It's been a choppy part. The interesting one is actually that I suppose the NASDAQ composite or the NASDAQ 100. Ironically, at this point so far, I'm not seeing, I saw a bit of volatility, but I'm not seeing on the macro clear evidence yet that we've can't go higher on the crazy tech stocks. I think people have to, which doesn't mean I am saying they are well valued. Liquidity is finding itself into other areas where there is great liquidity. Some of the problems that silver have is that you need an immense amount of storage for even small amounts of money. And this is also the case with exploration, minor companies and all of that. They're almost, because they've become so undervalued, their undervaluation is almost part of the problem of investing. Lack of liquidity for big institution players to come in. It's really tough to make it worth their while to get into things that have such low market caps. So a lot of liquidity where it is around will tend to follow into the trillion market cap magnificent sevens. You have a lot of trackers which are inherently brainless. They aren't asked, how is the state of the financial system? Do we have a debt Ponzi scheme on our hands? They're just a computer bot buying program that says, buy the things that are going up and eliminate the ones that aren't, or reduce, keep waiting on the winners. And that's why we've gone from the breadth of typical markets. And they used to say the Nifty 50, they thought it was quite significant that the stock market was moving up on only 50 stocks way back in I think it was the 50s and 60s. And then that was considered narrow. And of course, today, as a result of keep pushing the winners and keep eliminating the ones that aren't going up as fast in an index, you tend to get an ever narrowing, it's the natural outcome, is you get an ever narrowing and spiking asset class that defy valuations for a while. And that seems like that process can still continue for a while. There's no clear-cut head and shoulders. There has been a bit of volatility. The carry trade events are certainly showing there's some stress between the lending that has gone on in Japan and the investing potentially in the States, which can also be done by non-American institutions as well. So people think this is just a US-Japan thing. The Swiss National Bank might be borrowing for all you know. I don't think so, but I'm just saying investors and asset managers anywhere in the world could be exploiting that, including even in Japan, borrowing cheap and putting in treasuries, etc. But the big thing for me is the debt devaluations. The debt devaluations and the yen slight uptick in interest rate, what a response that caused. And unlike Bloomberg, I do not assess that 75% of the carry trade has unwound at all in that one thing. I think the carry trade has been an accumulation of 2.5 decades worth. Some of it's quite structurally long. And I find myself asking, how do primary dealer banks like JP Morgan and Goldman Sachs that often have to keep the government debt issuances that aren't being bought by pension funds, how do they make money on that? And the answer might have been they get to borrow the money for buying it at a much lower rate on the USD JPY. And if you look at recent tweets, forgive me, I'm going to just see if I can spot the tweet that I had at hand that had the unrealized losses. I'll have to find that for you. Unrealized losses in FDIC-backed institutions of non-equity nature. And these are about 10 times the degree of 2008 and the COVID era. So what that points to is people that are debt corporations that are FDIC-backed, that are heavily holding debt instruments, in my opinion. I would almost point my hand single-handedly at that. And these institutions could be, they purchased them at book, they haven't been marked to market value, and in some instances, ergo our charts that we've shown on previous appearances of TLT and ETFs of that nature. In some instances, those long-term debt instruments have lost between 40 and 45%. Which is crushing. And the turning of the debt market as an asset class on a basis of utter abundance and proliferation is going to be the bankrupting of the banking system if they are bag holders in any way of that asset class. And where do you run? You run to the only sound money you have that doesn't have a T-bill asset and liability accounting system, physical gold.
And I think it's really important for our viewers to understand that if the assets were marked to market, then they would be significantly lower than what is being claimed on the balance sheet, right? So it seems like then the risk is if there's a run on the banks, right, then the banks don't have the funds that they're claiming to have because they'd have to sell their assets and it would be sold at a huge discount from that. So essentially, the risk right now is if there's a run on the bank won't be able to pay you.
100%. I would say, first of all, from a cash perspective, they don't have that amount of cash, even if they were. I think cash, depending who you ask and which country you're talking about, there's between 3 and 7% odd of the cash that's around. I found that tweet. I just think it's worth to give color so that people can see that chart. Unrealized gains or losses on investment securities. Source FDIC. This is on unrealized losses on securities, solely reflecting the difference between the market value currently and the book value when it was purchased of non-equity securities as of the end of the quarter. So you're looking at that red box in comparison to 2008, which I'll just help sketch for you, and the events leading into 2019/20. And you can see that the scale of that is absolutely huge. So the potential for, if those were to, there's probably bankrupt institutions in there that are desperate. And that, I think, is one of the reasons why the dollar has ceased to have the strength and has had to weaken a little bit, so that the debt markets collapse can actually get a bit of a bid, because the talk of cuts has seen yields coming down and have put a bit of a bid back under the debt market. If you over-release, you have 2 taps to release the pressure in your hot water tank. If you're only using the 1 tap, you end up with a possibility that the other tap clogs. You've got to stop the one and use the other one every now and then. And this is what we're seeing: a weaker dollar and actually a little bit of a floor for the debt markets and a bid back up. And that's where the rate cuts have come in. But the problem with that is they can't pull the cuts too far, because there'll be a lack of bid of people willing to buy the debt markets on the basis they are not accepting the new prices as it firms. And that could see rates, the market diverging from the Fed in terms of the rates and the valuations they place on the debt markets. And Elijah, that's my call for the next major shoe to drop. The minute that happens, It's almost like the divergence in paper gold and actually with premiums physical gold. It is a major, major indicator. If the Federal Reserve wants to do even more cutting because of that utterly crushed consumer, who should be acknowledged to have been in a recession for the better part of, at least 9 months, maybe a year, or at least been in and out of recessions for an extended period. If they cut too far and the bond market stops moving on their talk to cut. So when the market stops reacting and starts calling their bluff and wants to actually go higher rates, in other words, devalue their debt even more, which we need, despite the talk of the Fed, that is the beginning of the great unwind, because everybody thinks the central bank entirely has full remit of controlling rates. It does until the market no longer wants them at that price. And that's a huge loss of face, and that would be a capitulation. Then you would just see it fall and run away. And that's the beginning of the end.
Well, it will be exciting times ahead. It's it's great to always have you give us this update, Francis. If people are interested in really tracking the day-to-day with you, they can go to your YouTube channel or your website. Can you tell us a bit about that?
Yes, sure. Join us at the Market Sniper, the YouTube channel. Follow for free. We share trades for people that are a little bit more active. It's not 9 screens and day-to-day stuff. It's a possibility for you to add a little bit of alpha. So apart from being investors in gold ourselves, you could have had a leverage long on gold during this period, mild leverage with known stocks, and they've been short oil during this big sell-off, and generally still been commodity neutral, and added a bit of alpha, turning those profits into silver and gold with institutions like yourself, Elijah. And that's what we aim to do, maximize the opportunities that a once in a lifetime, almost economic case study is going to present to us, and build optionality for protecting that additional wealth that we make as well. And you do it by following us on the YouTube channel, The Market Sniper.
Fantastic. Francis, thank you so much for your time today. As always, any last thoughts before we let you go?
No, keep stacking the gold and silver. Bless everybody out there. Keep your chin up, get out and live life. And don't let the events and the news and the politics spoil your day.
Sounds good. Definitely in this season, don't let the politics spoil your day is a good piece of advice there. So thank you so much, Francis.
Don't let them eat your dog.
Definitely. Thank you so much, Francis. Have a great day.
All the best. Bye-bye for now.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.